Efficient capitalism: how community banks can reduce costs and increase returns to investors. We'll first start with how we add money into the economy. Banks create new money by issuing debt. They open a loan account which records how much you owe the bank. The bank puts money into your trading account. It is now available for you to use. The bank created new government money. We can't just keep adding money to the economy. We have to remove the excess money. Two ways of removing money. First of all, repay the debt, and the bank will cancel the money, the reverse of creating it. Another way is to buy or build assets. The asset's value will be reduced through depreciation, which removes the money from circulation. Both ways are good, but the bank makes unnecessary transactions. Every month, the bank adds it to the amount you owe, and that's a debit. There has to be a credit for the debit, and that credit is capital into the bank's money owed account. So the money that gets created from debiting your loan account is given to the bank. This guarantees that we'll have inflation and obscene differences in wealth. The technical term for this behavior by the banks is capitalisation of interest. Borrowers pay interest twice for new money. Wealthy people can buy the money quickly so they don't pay any interest or very little. Governments and community organisations get new money with debt and pay interest twice. That's just not fair, and it's unnecessary. Let's see what's happened because we've capitalised interest. Today, 91% of new wealth goes to the wealthiest 25% of the population. The bottom 25% go into debt. That's just not right. Back in the 1960s, the wealth distribution was much more even. Everyone got about the same amount of new wealth because there was less capitalisation of interest with the credit unions, which in the past dominated home lending. Let's now see what happens if we use this approach. We lower the cost by removing interest capitalisation. The government and community organisation guarantee that they will use the money to build or buy assets and share ownership of the assets with those who use them. The depreciation of the assets removes the money. And that means that the bank fees, that the cost of the bank fees are paid from the payments for the property, and the community banks can supply communities with the new money without interest, just the fees. This means that outcomes when we remove the cost of interest for a group of houses. The owners and occupiers will pay the cost of the house the same as wealthy people, not 3 times the cost, and the bank fees are included in the price of the house. Investors and financial institutions will receive 10% indexed annuities for 20 years. This is at least twice as good as they could get from any super fund or bank annuity. If they use this, governments will recycle the money and typically get 3 times the assets for the same amount. Personal income tax will be reduced, and organisations that make profits and consumption taxes will dominate the collection of tax. The wealth distribution will go back to what we had in the 1960s. Removing interest and forming household cooperatives will leave house prices the same, but make housing affordable. And the redistribution of wealth in housing will be at the same rate for housing cooperative members. The new wealth is distributed based on the payment for the new asset. The same process can be done for all assets. The next video will describe how a group of occupiers, investors, and a community bank can set up a local housing not-for-profit cooperative. You will receive it if you subscribe to this YouTube channel. Thanks for listening.